Welcome to our comprehensive guide on interpreting financial ratios. Whether you're a business owner, investor, or student, understanding financial ratios is crucial for making informed decisions. In this video, we'll break down what financial ratios are, why they matter, and how you can use them to analyze a company's performance. We'll start with the basics, then move into specific types of ratios, and finally show you how to interpret the results. By the end, you'll feel confident reading financial statements and extracting meaningful insights. Let's dive in and unlock the power of financial ratios together. Financial ratios are numerical values derived from a company's financial statements. They help us compare different aspects of a business, such as profitability, liquidity, and efficiency. By analyzing these ratios, we can quickly assess a company's financial health and performance over time. Ratios are especially useful for comparing companies within the same industry, as they provide a standardized way to measure success. In the next scenes, we'll explore the main categories of financial ratios and how each one can offer unique insights into a business's operations. Why should we care about financial ratios? Simply put, they turn raw financial data into actionable information. Investors use ratios to decide where to put their money, managers use them to improve operations, and lenders use them to assess risk. Ratios help us spot trends, identify strengths and weaknesses, and make better predictions about the future. Without ratios, financial statements can be overwhelming and difficult to interpret. Next, let's look at the main types of financial ratios you'll encounter. Financial ratios fall into several main categories: liquidity, profitability, efficiency, solvency, and market value ratios. Each category focuses on a different aspect of a company's financial health. Liquidity ratios measure a company's ability to meet short-term obligations. Profitability ratios show how well a company generates profit. Efficiency ratios reveal how effectively resources are used. Solvency ratios assess long-term stability, and market value ratios reflect investor perceptions. We'll explore each category in detail, starting with liquidity ratios. Liquidity ratios help us determine if a company can pay its bills as they come due. The most common liquidity ratios are the current ratio and the quick ratio. These ratios compare a company's liquid assets to its short-term liabilities. A higher ratio generally means better liquidity, but too high could indicate inefficiency. In the next scenes, we'll break down each liquidity ratio and show you how to calculate and interpret them. Current ratio is calculated by dividing current assets by current liabilities. It tells us how many times a company's short-term assets can cover its short-term debts. A current ratio above 1 suggests the company can meet its obligations, while a ratio below 1 may signal trouble. However, an excessively high ratio could mean the company isn't using its assets efficiently. Let's see how this ratio works with a simple example in the next scene. Imagine a company with $200,000 in current assets and $100,000 in current liabilities. The current ratio would be 2, meaning the company has twice as many assets as liabilities. This suggests strong liquidity and a good ability to pay short-term debts. However, if the ratio were much higher, say 5, it might indicate that the company is holding too much cash or inventory, which could be invested elsewhere for better return. Next, we'll look at the quick ratio, which offers a more stringent test of liquidity. Quick ratio, also known as the acid test ratio, measures a company's ability to pay short-term obligations without relying on inventory. It's calculated by subtracting inventory from current assets, then dividing by current liabilities. This ratio is especially important for businesses where inventory may not be quickly converted to cash. A quick ratio above 1 is generally considered healthy, but as always, context matters. Let's see how to interpret this ratio in practice. Suppose a company has $150,000 in current assets, $50,000 in inventory, and $100,000 in current liabilities. The quick ratio would be 150,000 50,000 / 100,000 equals 1. This means the company has just enough liquid assets to cover its short-term debts without selling inventory. If the quick ratio is much lower than the current ratio, it may signal that a company relies heavily on inventory to meet obligations. Next, we'll move on to profitability ratios. Profitability ratios show how well a company generates profit from its resources. These ratios are key for investors and managers who want to know if the business is making money efficiently. Common profitability ratios include gross profit margin, net profit margin, return on assets, and return on equity. Each ratio offers a different perspective on profitability. In the following scenes, we'll break down these ratios and explain how to use them for analysis. Gross profit margin is calculated by dividing gross profit by revenue. It tells us what percentage of sales remains after covering the cost of goods sold. A higher gross profit margin means the company retains more money from each sale, which can be used to cover other expenses. This ratio is especially important for companies in competitive industries, where small changes in margin can have a big impact. Next, we'll look at an example to see how this ratio is applied. Say a company has $500,000 in revenue and $300,000 in cost of goods sold. The gross profit is $200,000, so the gross profit margin is 40%. This means that for every dollar of sales, the company keeps 40 cents after paying for the products it sells. A declining gross margin could indicate rising costs or increased competition. Next, we'll discuss net profit margin, which takes all expenses into account. Net profit margin is calculated by dividing net income by revenue. This ratio shows what percentage of sales is left after all expenses, including taxes and interest, are paid. A higher net profit margin means the company is more efficient at converting sales into actual profit. This ratio is useful for comparing companies of different sizes, as it standardizes profit relative to sales. Let's see how this works with a practical example. Imagine a company with $1 million in revenue and $900,000 in total expenses. The net income is $100,000, so the net profit margin is 10%. This means the company keeps 10 cents of every dollar earned after all costs. A low or declining net margin could signal rising costs or pricing pressures. Next, we'll explore return on assets, which measures how efficiently a company uses its assets to generate profit. Return on assets, or ROA, is calculated by dividing net income by total assets. This ratio tells us how effectively a company uses its assets to generate profit. A higher ROA means the company is making good use of its resources. ROA is especially useful for comparing companies in asset-heavy industries. However, it's important to consider industry norms when interpreting this ratio. Next, we'll look at a simple example to illustrate ROA. Suppose a company has $50,000 in net income and $500,000 in total assets. The ROA would be 10%. This means the company generates 10 cents of profit for every dollar invested in assets. If ROA is low, it may suggest the company is not using its assets efficiently. Next, we'll discuss return on equity, which focuses on returns to shareholders. Return on equity, or ROE, is calculated by dividing net income by shareholders' equity. This ratio shows how well a company uses shareholders' funds to generate profit. A higher ROE means better returns for investors. ROE is a favorite metric for investors because it reflects management's ability to grow the business. However, very high ROE can sometimes be a red flag indicating excessive debt. Next, let's see an example of ROE in action. Imagine a company with $80,000 in net income and $400,000 in shareholders' equity. The ROE would be 20%. This means the company generates 20 cents of profit for every dollar of equity. A rising ROE is generally positive, but if it's driven by high debt, it could increase risk. Next, we'll move on to efficiency ratios, which measure how well a company manages its resources. Efficiency ratios help us understand how well a company uses its assets and liabilities to generate sales and maximize profits. Common efficiency ratios include inventory turnover, accounts receivable turnover, and asset turnover. These ratios are especially important for businesses that manage large inventories or have significant receivables. In the next scenes, we'll break down each efficiency ratio and show you how to interpret them. Inventory turnover is calculated by dividing the cost of goods sold by average inventory. This ratio tells us how many times a company sells and replaces its inventory during a period. A higher turnover means inventory is sold quickly, which is usually positive. However, too high a turnover could indicate insufficient inventory, leading to lost sales. Next, we'll look at an example to see how inventory turnover works in practice. Suppose a company has $300,000 in cost of goods sold and $50,000 in average inventory. The inventory turnover ratio would be 6. This means the company sells and replaces its inventory 6 times a year. If the ratio is much lower, it may suggest overstocking or slow-moving goods. Next, we'll discuss accounts receivable turnover, which measures how quickly a company collects payments from customers. Accounts receivable turnover is calculated by dividing net credit sales by average accounts receivable. This ratio shows how efficiently a company collects money owed by customers. A higher ratio means faster collection, which improves cash flow. However, if the ratio is too high, it could mean the company has strict credit policies that might drive customers away. Let's see an example to clarify this concept. Imagine a company with $400,000 in net credit sales and $50,000 in average accounts receivable. The accounts receivable turnover ratio would be 8. This means the company collects its average receivables 8 times a year. A low ratio could indicate collection problems or lenient credit terms. Next, we'll look at asset turnover, which measures how efficiently a company uses its assets to generate sales. Asset turnover is calculated by dividing net sales by average total assets. This ratio tells us how efficiently a company uses its asset to generate revenue. A higher asset turnover means the company is generating more sales per dollar of assets. This ratio is especially useful for comparing companies in industries with different asset requirements. Next, we'll see an example to illustrate asset turnover. Suppose a company has $1 million in net sales and $500,000 in average total assets. The asset turnover ratio would be 2. This means the company generates $2 in sales for every $1 of assets. A low asset turnover could indicate underused assets or operational inefficiencies. Next, we'll move on to solvency ratios, which assess a company's long-term financial stability. Solvency ratios measure a company's ability to meet its long-term obligations. These ratios are important for lenders and investors who want to assess financial risk. Common solvency ratios include the debt-to-equity ratio and the interest coverage ratio. A healthy solvency ratio suggests the company can survive financial challenges and continue operating in the long run. Let's start by exploring the debt-to-equity ratio. Debt-to-equity ratio is calculated by dividing total liabilities by shareholders' equity. This ratio shows how much of the company is financed by debt versus equity. A higher ratio means more debt, which can increase risk but also boost returns if managed well. A lower ratio suggests a more conservative approach. Next, we'll look at an example to see how this ratio is used in practice. Imagine a company with $600,000 in total liabilities and $400,000 in shareholders' equity. The debt-equity ratio would be 1.5. This means the company has $1.50 in debt for every $1 of equity. A rising ratio could signal increasing risk, especially if earnings are volatile. Next, we'll discuss the interest coverage ratio, which measures a company's ability to pay interest on its debt. Interest coverage ratio is calculated by dividing earnings before interest and taxes, EBIT, by interest expense. This ratio shows how easily a company can pay interest on its debt. A higher ratio means the company has more than enough earnings to cover interest payments, reducing the risk of default. A low ratio could signal financial distress. Let's see an example to clarify this ratio. Suppose a company has $120,000 in EBIT and $30,000 in interest expense. The interest coverage ratio would be 4. This means the company earns 4 times its interest payments, which is generally considered safe. If the ratio drops below 2, lenders may become concerned about the company's ability to meet its obligations. Next, we'll move on to market value ratios, which reflect investor perception. Market value ratios help investors assess a company's stock price relative to its earnings, book value, or sales. Common market value ratios include price to earnings, PE, price to book, PB, and price to sales, PS. These ratios are especially important for investors deciding whether a stock is undervalued or overvalued. In the next scenes, we'll break down each market value ratio and explain how to interpret them. Price to earnings ratio, or PE, is calculated by dividing the market price per share by earnings per share. This ratio tells us how much investors are willing to pay for each dollar of earnings. A high PE may indicate high growth expectations, while a low PE could suggest undervaluation or low growth prospects. Next, we'll look at an example to see how the PE ratio is used. Suppose a company's stock trades at $50 per share and its earnings per share are $5. The PE ratio would be 10. This means investors are willing to pay $10 for every $1 of earnings. Comparing PE ratios across companies helps investors identify potential bargains or overpriced stocks. Next, we'll discuss the price-to-book ratio, which compares market value to book value. Price-to-book ratio, or PB, is calculated by dividing the market price per share by book value per share. This ratio shows how much investors are willing to pay for each dollar of net assets. A PB ratio above 1 means the stock is trading above its book value, which can be a sign of investor confidence. A low PB may indicate undervaluation or potential problems. Let's see an example next. Imagine a company's stock trades at $20 per share and its book value per share is $10. The PB ratio would be 2. This means investors are paying $2 for every $1 of net assets. A very high PB could signal overvaluation, while a low PB might indicate a bargain or underlying issues. Next, we'll discuss the price-to-sales ratio, another useful valuation tool. Price-to-sales ratio, or PS, is calculated by dividing the market capitalization by total sales or the stock price per share by sales per share. This ratio helps investors value companies that may not yet be profitable. A lower PS ratio can indicate undervaluation, while a higher ratio may reflect high growth expectations. Let's see an example to clarify this ratio. Suppose a company has a market capitalization of $500 million and annual sales of $250 million. The PS ratio would be 2. This means investors are paying $2 for every $1 of sales. Comparing PS ratios across companies can help identify undervalued or overvalued stocks, especially in industries where profits are volatile. Next, we'll discuss how to use ratios together for a complete analysis. A single ratio tells the whole story. The best analysis comes from looking at multiple ratios together. For example, a company may have strong profitability but weak liquidity, or high growth but excessive debt. By combining liquidity, profitability, efficiency, solvency, and market value ratios, you can get a well-rounded view of a company's strengths and weaknesses. In the next scenes, we'll look at some practical tips for interpreting ratios. In interpreting ratios, it's important to compare them to industry benchmarks. What's considered a healthy ratio in one industry may be risky in another. For example, retailers often have lower current ratios than manufacturers. Always check how your company's ratios stack up against competitors and industry averages. This context helps you make more accurate assessments. Next, we'll discuss the impact of company size and growth stage. Company size and growth stage can greatly affect financial ratios. Startups may have low profitability but high growth, while mature companies might show stable margins and lower growth. When analyzing ratios, consider where the company is in its life cycle. This perspective helps you avoid misinterpreting results and making poor decisions. Next, we'll look at the importance of trend analysis over time. Looking at ratios over time reveals important trends. Is profitability improving? Is debt increasing? Trend analysis helps you spot positive or negative changes before they become obvious in the bottom line. Always review several years of data to understand the direction the company is heading. This approach provides deeper insights than a single snapshot. Next, we'll discuss the limitations of financial ratios. While financial ratios are powerful tools, they have limitations. Ratios rely on accurate financial statements, which can be affected by accounting choices or errors. They also don't capture qualitative factors like management quality or market conditions. Use ratios as a starting point, but always supplement your analysis with other information. Next, we'll look at some common mistakes to avoid when interpreting ratios. Common mistake is relying too heavily on a single ratio or failing to consider industry context. Another pitfall is ignoring changes in accounting policies, which can distort ratios. Always check the notes to financial statements for important details. Remember, ratios are just one part of a thorough analysis. Next, we'll summarize the key takeaways from this video. Sum up: financial ratios are essential tools for analyzing a company's performance. By understanding liquidity, profitability, efficiency, solvency, and market value ratios, you can make better business and investment decisions. Always compare ratios to industry benchmarks, consider company size and trends, and be aware of their limitations. With practice, interpreting financial ratios will become second nature. In our final scene, we'll encourage you to apply these concepts in your own analysis. Now that you've learned how to interpret financial ratios, it's time to put your knowledge into practice. Start by reviewing the financial statements of a company you're interested in. Calculate key ratios, compare them to industry averages, and look for trends over time. Remember, the more you practice, the more confident you'll become in your analysis. Thanks for watching and happy analyzing.